Smart money is taking massive profits on the biggest tech giants in the world, while old guard financial titans are quietly preparing a $20 billion war chest to buy up everything left behind. Hello, this is Warm Insight. Today we're going to talk about the hidden capital rotation that is completely shifting the global financial battlefield right now. Leaving a like and subscribing is a huge help to us. Imagine a grand symphony orchestra performing in front of a packed auditorium. For the last year, the star soloists have been playing the loudest, most aggressive, and most spectacular music imaginable. The audience is completely mesmerized by them. But suddenly, those star soloists begin to lose their rhythm. They start to sweat. The notes become slightly discordant. Meanwhile, deep in the back of the stage, the heavy brass and the percussion sections are slowly finding their own incredibly powerful beat. It is not chaos. It is a brand new, evolving musical composition forming right before our eyes. You need to listen closely to catch the new melody, because if you are still just staring at the soloists, you are going to miss the most important movement of the entire performance. This is exactly what is happening in the stock market today. We are seeing a sharp, violent split in market sentiment. The institutions, the hedge funds, the billionaires, the smart money, they are fundamentally rethinking the absolute dominance of big technology companies. We are currently tracking the systemic risk in big cap tech at a staggering 70%. This is a red alert level. Take a look at NVIDIA. It is a fantastic company with incredible technology, but buyers have absolutely walked out of the room. The stock is hitting an invisible wall of resistance. Retail investors keep throwing their paychecks at it because they see Wall Street analysts predicting targets of $330. But while the retail herd is blindly charging forward, the smart money is quietly slipping out the back door. They are taking their profits and leaving the everyday investor holding the bag. This is a classic liquidity trap. It is a psychological game, where the optimism of the crowd provides the exact exit liquidity that the billionaires need to cash out. To truly understand the danger of this moment, we have to travel back in time to the early 1970s. Wall Street was obsessed with a group of stocks known as the Nifty 50. These were 50 massive blue-chip companies. We are talking about Polaroid, Sears, Eastman Kodak, and Xerox. The narrative at the time was that these companies were so dominant, so innovative, and so perfectly managed that you could buy them at any price and hold them forever. The financial media called them one-decision stocks. You just buy them and never sell. Because of this absolute certainty, retail investors bid the prices up to astronomical valuations. The price-to-earnings ratios reached 80, 90, and sometimes over 100. The herd mentality was unbreakable. But then, the macroeconomic winds shifted. Inflation began to tick upwards. The Federal Reserve had to change its stance. And suddenly, the smart money realized that paying 100 times earnings for a camera company was financial suicide. The institutions started selling. The retail investors held on, believing it was just a temporary dip. The result was an absolute massacre. The bear market of 1973 to 1974 wiped out immense amounts of wealth. Many of those supposedly perfect Nifty 50 stocks lost 80 to 90% of their value, and some never recovered their previous highs. The companies did not disappear overnight, but their stock prices had completely disconnected from reality. We are witnessing that exact same psychological disconnection today. The constant noise from pre-market movers like Snowflake, Best Buy, and Kohl's muddies the waters. People are reacting to daily price swings rather than the underlying financial currents. We even see rampant insider trading charges on platforms like Polymarket. This is pure late-stage herd mentality. People are seeking quick, illicit, and speculative gains because they are blinded by the immediate prize. They want to get rich by tomorrow afternoon. This short-term focus entirely blinds the retail crowd to the real, deeper rotations underway. Look at Bitcoin. It is currently sitting at $75,000, but the trend is pointing downward. More importantly, it is completely decoupling from the tech rally. For years, crypto moved in lockstep with high-growth technology stocks. But now that chain is broken. This decoupling is a massive flashing warning sign. It signals a much broader risk aversion spreading through the financial system. The systemic risk in the crypto sector is currently sitting at an astronomical 85%. Capital is scared. But remember this fundamental rule of finance. Capital never sleeps. It merely moves. So where is the capital going? It is rotating into essential foundational technology components. Look at Micron. Micron just hit a $1 trillion market cap, and its trend is aggressively pointing upward. This is not a flashy consumer-facing artificial intelligence software company. This is the physical bedrock of the digital age. They make the memory chips. They make the hardware. Smart money is rotating away from the dreams of the future and burying their capital in the physical dirt of the present. This brings us to the most important historical parallel of our modern era. The peak of the dot-com bubble in March of the year 2000. Everyone and their grandmother was buying internet stocks. Companies that had no revenue, no profits, and no business plan were achieving multi-billion-dollar valuations simply by adding .com to their name. But behind the scenes, the smartest investors were looking at the companies, actually building the infrastructure. Cisco Systems was the darling of the era. They built the routers and the switches that made the internet function. Everyone knew the internet was the future, and they were absolutely right. The internet changed the world. But being right about the technology does not mean you are right about the stock market. Cisco stock was priced so high that when the bubble burst, the stock plummeted nearly 80%. The retail investors who bought the peak lost everything. But the smart money, the contrarians, they had already rotated out of the high-flying software dreams and moved their capital into boring value stocks, real estate and physical commodities right before the crash. Today, that identical rotation is happening. The transition from front-facing artificial intelligence plays into fundamental structural components. Like Micron is a move right out of the year 2000 playbook. While the retail herd is paralyzed by fear of missing out on tech, the old guard of traditional finance is aggressively hunting for value. Jamie Dimon, the legendary chief executive of J.P. Morgan Chase, is currently sitting on a $20 billion war chest, specifically designated for massive mergers and acquisitions. Think about that number, $20 billion. Why would the most powerful banker on the planet prepare to spend that kind of money right now? It is because he is a master of contrarian thinking. While the rest of the world is terrified of regulatory headwinds and lingering inflation, Jamie Dimon sees immense long-term value. He is like a seasoned grandmaster, chess player planning 5, 6, or 7 moves ahead. He is not just reacting to the last piece that moved on the board. He sees that the systemic risk in big banks is incredibly low right now, sitting at just 30%. He is buying resilience. He is buying assets that generate real cash flow today, not promises of cash flow 10 years from now. To understand the genius of this move, we must look at the panic of 1907. The United States financial system was on the absolute brink of total collapse, a failed attempt to corner. The copper market had triggered a massive run on the banks. The Knickerbocker Trust Company, one of the largest financial institutions in New York, collapsed into ruin. Panic swept through the streets. People were pulling their money out of every bank they could find. The stock market was plunging into an abyss. But John Pierpont Morgan, the founder of the very bank Jamie Dimon runs today, did not panic. He understood the power of having capital when nobody else does. Morgan locked the most powerful men in finance inside his private library. He forced them to pool their resources to save the banking system. But in doing so, he engineered massive, highly favorable acquisitions for his own firm. He bought up incredible steel and railroad assets for literal pennies on the dollar. He saw immense structural value, while everyone else was blinded by absolute terror. Jamie Dimon is executing the exact same strategy today. The $20 billion war chest is a statement of supreme confidence in the resilience of traditional financial institutions. It tells us that the smart money is finding spectacular opportunities, where the amateur only sees a regulatory nightmare. This capital reallocation is absolutely critical for you to understand. We are not in a simple rising tide anymore. A rising tide lifts all boats, even the ones with holes in them. But the tide is going out. The macro environment is incredibly complex right now. We are currently trapped in a massive ideological battle between the institutional bulls and the institutional bears. Let us break down both sides. The institutional bull case relies heavily on the concept of an economic soft landing. The bulls believe that the consumer balance sheets are still strong enough to withstand the current pressure. They believe that inflation will continue to cool down gracefully. This will theoretically allow the central banks to pivot and start cutting interest rates much sooner than expected. If rates go down, borrowing becomes cheaper. This stimulates broader economic activity and encourages corporations to invest heavily in expansion. In this scenario, the old guard, hunting massive deals proves that asset valuations are fundamentally attractive. Supply chains will completely normalize. Global trade will rebound, and we will see a massive broad market rally that rewards diversified portfolios and heavily favors overlooked quality companies. But there is a very dark shadow hanging over this optimistic view. The institutional bear case is a terrifying reality that we must prepare for. The bears warn that inflation is not dead. It is simply resting. They believe we are facing persistent, sticky inflation that will force central banks to maintain a higher for longer interest rate environment. If interest rates stay high, the economy will inevitably be tipped into a hard landing or a prolonged period of brutal stagnation. We are also facing massive geopolitical tensions, particularly in critical global energy regions and vital shipping trade routes. Any escalation in these areas could trigger massive new supply shocks, sending the price of oil and commodities skyrocketing and exacerbating inflationary pressures all over again. This sharp split in market sentiment could mean that the smart money is quietly bracing for a massive market correction. If corporate earnings outside of the top few, dominant tech firms begin to compress under the crushing weight of higher borrowing costs, things will get very ugly. A potential credit crunch, combined with massively overvalued segments of the market, could trigger a cascading domino effect. This would lead to widespread panic selling, forced deleveraging, and a massive, painful drawdown across all equities and risk assets. If you want to understand what a higher for longer inflationary environment actually feels like, we have to revisit the brutal stagflation era of the 1970s. The economy was completely trapped. Economic growth was stagnant, yet prices for everyday goods were skyrocketing. It was the worst of both worlds. The Federal Reserve, initially led by Arthur Burns, tried to appease the politicians by keeping monetary policy relatively loose. It was a catastrophic failure. Inflation raged completely out of control. It took the appointment of Paul Volcker, a man with a spine of absolute steel, to save the system. Volcker forcefully jacked interest rates up to nearly 20%. He deliberately choked the economy to break the psychological back of inflation. During this agonizing period, high-growth stocks were absolutely decimated. If you owned companies that promised profits, in the distant future you were ruined. The mathematical reality of discounted cash flow models meant that high interest rates destroyed the value of future earnings. The only investors who survived, and indeed thrived, were those who owned hard assets, real estate, physical commodities, and incredibly boring value, stocks that paid consistent, reliable dividends. This is exactly why the smart money is reevaluating growth stocks today. They know that if inflation returns, the tech giants will bleed. So, how do you protect yourself? How do you build generational wealth in an environment woven with threads of both fear and massive greed? You need a disciplined, emotionless strategy. You need the Titan's playbook. Rule number 1 is the generational bargain. You must understand that current market sentiment is wildly unpredictable. The Smart Money Flow Index is flashing massive divergence. The institutions are highly cautious, while the retail traders are high on exuberance. You cannot make decisions based on emotion. You must rely on a data-driven approach to capital allocation. Rule number 2 is the asset allocation seesaw. We advocate for a strict 55-35-10 portfolio. That is 55% in diversified stocks, 35% in safe defensive assets, and 10% in pure liquid cash. You need that 10% cash position. Cash is not trash. Cash is your ammunition. When the market inevitably panics and there is blood in the streets, you need capital ready to deploy immediately. For your 55% stock allocation, you must balance growth with defensive stability. Stop chasing the artificial intelligence hype. Increase your exposure to quality dividend funds. Look at ticker symbols like VIG and SCHD for pure income and absolute stability. Look at industrial materials like XLI, which will benefit massively from government infrastructure spending. Look at the healthcare sector like XLV, which offers incredible defensive characteristics and is supported by long-term demographic tailwinds, like an aging global population. You should also explore broad market value funds like VTV to capture opportunities in segments that possess incredibly strong fundamentals, but have simply been ignored by the massive tech hype. Rule number 3 is the global shield. The United States markets have delivered incredible returns over the last decade, but history shows us that dominance never lasts forever. The current environment heavily suggests reviewing your balance between domestic and international exposure, international markets, particularly in developed Europe, through funds like VEA, and select emerging markets, through funds like VWO and IEMG, currently offer vastly more attractive valuations. The old guard hunting massive deals is not just looking inside the United States. They are looking globally. Let me tell you about the lost decade of United States equities. From January of the year 2000 to December of the year 2009, the S&P 500 index delivered a total return of absolute zero. If you invested all your money in large-cap American companies, you lost 10 entire years of wealth compounding. You suffered through the dot-com crash and the great financial crisis. It was a decade of pure pain. But do you know what was happening outside the United States? During that exact same decade, emerging markets were absolutely exploding. Countries like China and India were rapidly industrializing. Value stocks and international equities produced life-changing returns, while the American markets completely flatlined. This is the mathematical reality of starting valuations. When a market becomes too expensive, the capital inevitably flows to where it is treated better. By strategically increasing your international exposure now, particularly to value-oriented international funds, you can drastically mitigate your concentration risk in a potentially plateauing American market. Rule number 4 is survival mechanics. In this complex opportunity, rich phase, you must practice strict dollar cost averaging. Do not try to time the market perfectly. Nobody can do that consistently. Consistently invest a fixed amount of money every single month, regardless of whether the market is up or down. This smooths out your purchase prices over time. Simultaneously, you must implement a disciplined risk management framework. Establish clear stop-loss levels for your individual speculative positions. Regularly rebalance your portfolio to maintain your 55-35-10 target allocation. Understanding your own personal risk. Tolerance is the only way to avoid making catastrophic emotional decisions. During periods of extreme volatility, here is your exclusive action plan. These are the exact triggers you need to watch for. Your first action is to initiate or aggressively add to defensive and value-oriented sector funds, specifically utilities under the ticker XLU or consumer staples under the ticker XLP. But you do not just buy them randomly. You wait for the trigger. Your trigger is the volatility index, known as the VIX. When the VIX sustains a level above 25 for 3 consecutive trading days, it signals that the broader market is consumed by absolute fear. That is when the defensive plays become incredibly oversold. That is your moment to strike. Your second action is to gradually increase your exposure to international value funds like EFAV or emerging market funds like IEMG. The trigger for this move is the United States Dollar Index, known as the DXY. If the dollar index shows a sustained downtrend, dropping below its 200-day moving average, it makes international assets massively more attractive for American investors. Furthermore, if international earnings growth significantly surpasses domestic earnings growth for 2 consecutive quarters, you must pull the trigger and allocate capital globally. Finally, here is the one critical mistake you must absolutely avoid. Do not chase speculative, hot sectors or individual meme stocks based purely on recent momentum or social media hype. Buying into assets with extremely stretched valuations and fundamentally weak balance sheets is a guaranteed way to destroy your wealth. When the market sentiment inevitably shifts, and as we have discussed today, it is already shifting, those speculative assets will be completely wiped out. This reckless approach directly contradicts the entire philosophy of the smart money. In moments of market divergence and perceived macro uncertainty, true opportunity never lies in predicting the next massive surge or the next apocalyptic crash. True opportunity lies in patiently positioning your portfolio for fundamental value and undeniable resilience. You must understand that the market's deep complexity frequently masks incredible underlying strength, but that strength is only visible to those who maintain a disciplined, data-driven, long-term perspective. Historically, periods marked by a sharp divergence in market sentiment are incredibly common. These transitions always precede massive shifts in economic cycles and the birth of entirely new market leaders. Disciplined investors who focus on broad diversification, intrinsic value, and patience during these terrifying times have consistently been rewarded with generational wealth.